Assalamu alaikum ji. Welcome to the second session. We'll be revising Unit 5 and Unit 6. Though some portion of Unit 5 we had covered in the first session, for major components of Unit 5, that is the financial management of the business, will be discussed today. Before we formally begin the class, it is imperative to look at the rules for the E-class once again. Please remember that you have to keep your mic and camera switched off at all times till you are asked to do otherwise. All your queries and questions will be answered. You are required to ask all the questions in the chat link. Session content, that is this presentation and the supporting content for this presentation for today's session, is available in the Google Classroom. In case of any technical problem, please either highlight on the chat link during the session or you can send an email to the given address. So, we move on to Unit 5 and Unit 6. Chapters 23 and 9. Some of the key learning objectives of today's session is to revise and help you remember the importance of financial management for a successful business and how these numbers are presented and recorded to facilitate effective decision making. How is profit and cash flow management done? How is profit calculated? How to interpret the financial performance of a business by calculating and analyzing profitability ratios and liquidity ratios. And above all, being able to comprehend and recognize the impacts of globalization and the external environment of a business and how a business is interacted or interrelated with the internal environment of a business and the external environment in which it exists. So the first thing to jog our memory is to ask, why is cash important for a business? A simple question based on common sense. We all know the importance of cash. For a business, cash is a liquid asset. So this means it's an asset which is immediately available for the business to use or spend on expenses. All businesses need cash. The business needs to have an adequate amount of cash to be able to pay for its short-term payments, be it the working expense, the working capital for running the business, or the short-term liabilities. So it is determined and it is an established fact that whether a business is profitable or in loss, any successful business to become successful, to become profitable, needs to manage its cash and needs to manage its cash flow. So what is meant by cash flow? Simple, and we are sure by now you're able to remember the concept. Cash flow is the inflow and the outflow of the cash for a business over a period of time. Cash inflows are all the sums of money received by the business over a period of time. This could be the money generated or the revenue generated through the sales or the money received the debtors, whereas the cash outflow is the money that business has to pay for, either sourcing the raw material or paying off the creditors. So what is meant by a cash flow cycle? This means that business is spending and business has to retrieve money from the market. So there is a cycle that exists. And when you look at the different stages as evident from the diagram displayed on your screen right now, business needs cash to pay for the raw material, wages, rent, repeated regular expenses, and for doing this, using these resources, goods and services are produced. These goods and services are marketed, promoted, distributed, and sold to the potential customers. As the businesses sell the goods and services, they receive cash for these goods and services, and then the cycle continues because a business would need to make more goods and services, and business cycle continues. So this means for an ongoing business, the cash inflow and the cash outflow is a regular cycle that the business maintain. Once again, to reinforce, there are different examples of cash inflows for a business, which may include sales revenue, payment from debtors, money borrowed from external sources like bank loans, the money from the sale of business assets. Sometimes businesses have to sell their assets to generate cash. Investors putting more money into the business, that is the increase in the owner's equity. Simultaneously, similarly, cash outflows could be purchasing goods and materials for cash, that's sourcing the raw material, paying wages, salaries, and other expenses, purchasing fixed assets. When businesses are doing well and you have accumulated wealth, you want to invest into fixed assets. Sometimes when you're making money and you're making good business, you want to expand your business operations, so you want to invest in purchasing fixed assets. Repaying loans could be a source of cash outflow, which business has to account for. Because once you're paying loan, cash is going out of the business. You have to pay the creditors of the business. This means cash is going till. So this actually tells us and brings us to the point that cash flow management is an important aspect for any business, for any successful business, for any profitable business. And it is very important to highlight here that while we talk about cash flow management and we talk about positive net cash flow, we should not mix it. Cash flows or cash is not equal to a business profit. So the cash forecasts help businesses plan efficiently, and this helps them not only plan the financial management but the operations management, because it's the cash that helps you keep growing and going. Now, a question comes in here when we're talking about imperativeness of cash flow. Can cash flow become a problem? And yes, if it is a negative cash flow, which means if businesses do not have enough cash to pay in the short term, yes, then it will become a problem. And to avoid all such problems, financial management or the financial managers or the financial experts, they keep planning for the businesses to avoid any negative cash flow. Negative cash flow means lack of cash for a business. And negative cash flow could be managed in the following ways. That is, you can increase your cash by taking some loans. You could do or you could avoid the negative cash flow by delaying the payment to the suppliers. You could ask the debtors to pay more quickly. You could delay or cancel purchase of capital equipment. So in the long term, to improve cash flow, the business will need to attract more investors, cut costs by increasing efficiency, develop more products, explore new markets, expand the sales volume, and many other options or a combination of. So once again, before we move ahead, note the net cash flow, since it's the difference between the total cash inflow and the total cash outflow. All the businesses would want to keep a positive net cash flow, which means they have enough cash available, they have enough money available to pay for the expenses. Which actually means that for paying for the expenses on a regular basis, on a periodic basis, on a monthly basis, businesses need to keep a certain amount of funds available for the usage, and this certain amount of funds is classified as working capital. Working capital is all of the liquid assets of the business, which is your current assets that could be quickly converted to cash to pay off the business's debts, that is your current liabilities. Thus, financial management revolves around the cash flow management as well as managing the current assets and liabilities. Important to remember, cash flow is not the same as profit. There might be a scenario where there is a profitable business but does not have good cash flow. This can happen. This is a sign of lack of good management practices. That if a business is profitable or it does not have cash. This could be a sign that maybe the business is paying long or offering long periods of credits. And there could be many other reasons also. But remember, cash flow of a business does not mean or show that it is the profit of the business. These are two different things. So, since we have discussed the profit aspect and we've highlighted that cash flow or the cash of the business is not the profit of the business. So what exactly is profit? Profit is the difference between sales revenue and the total cost. This means this is the incremental income that you have once you pay all the costs. Why is profit important to a business? For any business, profit is important because it's the reward for the enterprise, it's the reward for risk taking, which is the source of finance. It is one of the indicators of success. And remember, whatever kind of business we are talking about, profit is important. Even for a social enterprise, profit is important. Though it is not their primary objective, for social enterprises, welfare of the society becomes the primary objective, but they still want to make profit because if a business or a social enterprise is not making profit, they will not be able to continue their operations over a long period of time. So, even the social enterprises will strive to make profit so that they can sustain the business and they can keep going and growing. So the two main aspects to increase profit for any business is one, to reduce the costs, that is to control the costs to become efficient in operations management. Two, to increase the sales revenue. And for increasing the sales revenue, either you add new products to your product basket or you go to new markets or you promote your existing product line so that you could increase the sales volume, or you could adopt a combination of the two, reducing costs and increasing sales volume. So while businesses are working at finding out the right combination for increasing profitability, they have to keep the accounts in place. They have to keep the financial records in place. And these financial records help the business managers or the owners to take informed decisions. It facilitates decision making. So, different financial statements or the different financial records are reviewed periodically over a given period of time. And the two most important are the income statement and the financial statement. What is an income statement? An income statement is a financial document of the business that records all income generated by the business and also records all the costs incurred by the business so that profit or loss could be determined for a given period of time. So an income statement sometimes is also referred to as a profit and loss statement. And an income statement may look like this. It has different components. So if you look at this given statement, you see the sales revenue, you see the cost of sales, which helps us determine the gross profit. From the gross profit, you deduct the expenses and the interest paid, and you get the net profit. And from the net profit, once you've taken off the taxes, you have the money available through which you could pay dividends. And after paying the dividend, what you are left with is your retained earning or the retained profit for that year. So, the different components of an income statement, the main heads of an income statement is, first of all, the revenue, the sales generated by a business, either by selling goods or services. Then is the second component, most important, no income statement could be complete without it. That's the cost of sales. That's the cost of producing or buying the goods actually sold by the business during a period of time. The third component is the gross profit, which is the difference between the revenue and the cost of sales. And I'm sure you understand, if the revenue is greater than the cost of sales, the business will be in profit. But if the cost of sales is higher than the revenue, this means the business is incurring loss. The fourth component of an income statement is net profit, which obviously is calculated by deducting all expenses and overheads of the business from gross profit. The fifth important component that completes an income statement is the retained profit, is the retained earning. So an income statement looks like that, and when you look at this diagram, you will see that the difference between the sales revenue and the difference between the retained profit, it tells you that your revenue is not all the profit that you're making. From the revenue, that's the sales revenue, the money that you've generated through sales, you have to deduct the cost of sales, you have to deduct all the expenses, and then you have to deduct the tax that you have to pay to the government. You have to take out the dividends that you have to pay to the shareholders, and then you are left with a retained profit that you could reinvest into the business. So, always remember, your revenue will not be equal to your profit. Amongst the financial statements, one of the most important financial statement is the balance sheet, because it highlights the financial position of a business. It shows the value of the business. It highlights the assets and the liabilities and the owner's equity. So components of a financial statement or statement of your financial position are three main. One, assets. Second, liabilities. And the third is owner's equity. Holders' equity. What are assets? I'm sure you're able to define assets, as assets are those terms of value owned by the business. These could be fixed and non-current assets like buildings, vehicles, equipment, etc. Or these could be short-term assets or the current assets like inventories or trade receivables or the cash available with the business or the cash available in the bank accounts of a business. The assets could be tangible or intangible as well. The intangible assets includes the value of your brand. And I'm sure you understand that these are the non-current assets. And you understand these intangible assets are not physically available. These are the assets that our business actually develop through their image building, through their brand promotion. For example, if today somebody tells you that Coke is coming up with a new brand, you could immediately establish and conceive a certain value associated with this new brand, even if you're not familiar with that new brand, even if when you've not tried that new brand. But because of the Coke's brand equity, because of the Coke's brand value, you will certainly feel a little more confident. Similarly, a brand like Nike, I'm sure as you get to hear that Nike is launching a new pair of joggers or sneakers or some running shoes, you will be having a certain kind of image associated with it. You will have a certain kind of confidence in the brand. So that's the intangibility of the brand value. And it turns out to be an asset for any business. The second important component of the statement of financial position is liabilities. As we all are familiar, liabilities are the debts owed by the business to its creditors. Like assets, these could be long-term or short-term, and the long-term type of debts could be loans or the debentures that do not have to be repaid within 1 year. The current liabilities could be the trade payables to the suppliers or maybe the overdraft facility used by a bank, and these are mostly the payables within 1 year's time period. Owner's equity or the shareholders' equity as is evident from its label is the total amount of money invested in the company by shareholders. So while you are looking at a financial statement from the assets, liabilities and the owner's equity, you could determine that what is the financial position of a business. And shareholders' equity is determined by deducting total assets and total liabilities. That turns out to be the formula for any financial position. There are different uses of financial statement or a financial position which managers or the business owners can use at various different times and at various scenarios. Majority of the time, the statement of financial position, as the label itself explains, is used to show a company's financial strength. When and why would you want to show a company's financial strength? Either while you are aiming to borrow some more money from a financial institution, or you want to sell some shares in the market, or you want to uh, grow your business and increase or attract some investors, you need to show the financial position of your company, your business, and you need to highlight these three important components: assets, liabilities, and owner's equity. Now, while you're recording all this financial data, you need to use this for certain purposes to make informed decisions. And some of these analysis involve the ratio analysis most commonly used. It is the comparison of line items in the financial statements of a business. Ratio analysis is used to evaluate a number of issues within an entity, such as its liquidity, its efficiency of operation, and profitability. And all these ratio analysis are not the only representation for a business, and all of these could have their own limitations. And also remember that this ratio analysis are based on the past accounting data, so might not be the true reflection, but still it helps in evaluating. So, like we're talking about liquidity ratios, we have different profitability ratios also. At any given time, you want to see the profitability of a business, and you could do it through determining the return on capital employed, gross profit margins. So, what is the return on capital employed? It is the net profit by capital employed as a percentage. So this tells you that's the return, what's the kind of return this business is offering to its investors. An aspect highlighting the financial strength of the business, performance of the business. Similarly, the gross profit margin, since the gross profit is determined through, yes, deducting the revenue deducting the cost of production through the revenue. That's sales minus cost of production. So it actually tells you about the efficiency of the operations management. So gross profit margin for each unit tells you that how the sale of product is contributing to the profitability of a business. So higher the gross profit margin, the better the business is doing. Similarly, you have net profit margin, and you know it that you get net profit once you have deducted all expenses from the gross profit. Now, like higher the gross profit, higher the better the business position is. Similarly, higher the net profit is, more attractive the business is. But always remember, net profit and gross profit will not be equal. These are two different types of profit a business calculates. So before we go on to the liquidity ratios, since I've just mentioned about the gross profit and the net profit, I want you to read through in your book and then attempt the quiz listed in the Google class, which has some multiple choice questions related to the difference between the gross profit and the net profit. After that, we come down to the liquidity ratio. Now, it's very important to understand what is liquidity. Liquidity is the ability or the capacity of the business to pay back its short-term debts, to pay off its current liabilities. So remember, do not mistake liquidity for liquid cash. Liquid cash means the hardcore cash money that you have available. Liquidity means the ability to actually pay off your current liabilities. So, what are the two different main liquidity ratios that businesses mostly deal with? This current ratio and the asset test ratio. And I'm so sure by now you are able to recall the formulas as well. Current ratio current assets versus current liabilities. It tells you what is the financial position of a company, how well the company is placed to pay off their liabilities, that's the short-term liabilities. Similarly, the asset test ratio or the liquid ratio, it is similar to current ratio, but in the current assets, you deduct inventories before you are evaluating it versus the current liabilities. Because a high level of inventory in a business can cause a big problem or can cause a problem or create a difference between its current and liquidity ratios. And this tells you that if you're keeping high level of inventories, you're actually impacting and you're actually using your cash unnecessarily. So these ratios have different applications. So here you get to see what is liquidity and why is it important for a business to maintain good capacity to pay their short-term debts. Very important to understand here the difference between profitability and liquidity. So, profitability is the ability of a business to earn profit. Liquidity is the ability of the business to pay off the short-term debts. So, it is important to remember the use of these interrelated terms for evaluating a financial scenario of a business. As you are now equipped and you've revised the financial scenarios, it is very important to understand the businesses do not exist in isolation. All businesses have two kinds of environments, the internal environment and the external environment. Any business can control their internal environment, but all businesses have to respond to the external environments. No business can control their external environment. So, for example, if in an economy there is a slump or there is a recession, so the businesses will have to adjust and respond accordingly. Like in today's time, we all are hearing about the influence of COVID-19, the coronavirus, on our regular daily lives and accordingly on our business lives as well. So, the businesses, all businesses, they cannot control their external environment, they cannot control the corona happening or the spread or the threat, but they have to adjust and respond accordingly to maintain their stability, their growth, their patterns. So, how are the economic growths of an economy determined and how businesses feel during a stage of economic growth? So, economic growth is an increase in the capacity of an economy to produce goods and services. That is the gross domestic product. So the gross domestic product, if it increases, if the GDP of an economy is increasing, it's showing a healthy positive sign. Means the businesses will have better opportunities to grow. And we all know all businesses, all economies do not just exist in the stage of growth. There are different stages and there are different phases that different countries and different economies go through. So there are different stages and these stages are classified as different positions and they become part of a business cycle. The business cycle is the fluctuation in economic activity that an economy experiences over a period of time. So the business cycles could be different types of growth, recession, recovery period, and no economy is always in one phase, or it does not stay continuously in one type of economic stage. There is always a cycle which is evident from the diagram you can see on your screen. So, what is a boom or a peak? Obviously, it's one of the most positive stages or the phases of a business cycle where the GDP is increasing, where there are lots of opportunities, market size is growing, industries are growing, there are lots of opportunities, goods are selling, and there is a lot of employment, and all businesses enjoy the boom period because the expansion is at its reverse of the boom is a recession. A recession where, business opportunities are curtailed. For example, a period that we are currently passing through is a period which is indicating or showing the trends towards a recession because of the lockdown, because of the threat of the virus spread. The businesses are not operating at their full potentials. So the spendings are there, but the sales are not as much. So this is a period where, businesses are not growing, rather their sizes are being curtailed, consumer purchases are falling off, employment may be increasing. So recession is not a stage or a period that business look towards. Recession is when things are going down, and one of the difficult parts or one of the challenging phases of recession is a slump where everything is kind of slowed down, where unemployment is at its peak, businesses are not finding many opportunities, banks are not lending on easy terms, and economy is suffering. And I'm sure you can understand during a stage or a phase of slump how businesses will have to respond and prepare themselves for the foreseen times. Recovery is a stage where everybody together is trying to take the economy back to towards the growth cycle. So government policies and the businesses together, they are trying to undertake the measures to increase the demand and then to be able to meet that demand. So this is the recovery phase where there are, lots of signs of positive development and businesses start looking positive, enthusiastic, and anticipating growth. I'm sure the growth itself is the word itself triggers the thought and has all the positivity associated with it. This is the best time that businesses want to enjoy because businesses are all about profitability and growth. Any business which has a growth potential goes a long way. And this is the phase when, businesses are earning high profits and they're forward to, including more. So all governments are always looking at responding and changing policies so that they could achieve the economic growth cycle, the economic growth, they could reach the economic growth stage, and so that they could help the businesses flourish, increase profits, increase their sales. The more the businesses are selling, the better conditions become. So businesses, as we've already said, are part of an external environment and they want to operate on profitability responding to their external environment. So businesses has responsibilities towards the external environment. And I'm sure you must have heard of certain issues. An example that we keep discussing every now and then is that while businesses are operating and they are part of a social system, they need to be conscious that they should not be damaging the environment or the society or the neighborhood. So, businesses have more responsibilities towards the society, just as they have responsibility for their internal environment, just as they have responsibility towards the workers or those associated with the businesses have responsibility towards the society as well as a whole. And sometimes the businesses add positive benefits to the society, and sometimes there could be some negative side of a business. So these negative impacts of the business on the society are called externalities. So social costs of a business is the private cost plus the external costs, and the social benefits are the private benefits plus the external benefits. So it is important, and it is actually governed by the government of all countries and economies, that the business should not only be concerned with the private benefits, they should be concerned and they are held responsible for the external benefit. For example, packages, where packages mall has been established, on the same place there was a factory by packages, and eventually, since when initially packages was established, the population growth has not reached that level, and it was supposed to be a little outside the main city area. Now, since it has become close to the residential area, and it was having negative impact, the fumes or the working of the factory had started impacting the residential area. So eventually, Package's factory is moved to another place, and the business has used that place to establish a shopping mall there. So businesses have to be held responsible, and businesses have to take decisions so that their private benefits do not exceed the external benefits or the costs. Businesses have to look at the sustainability of not just their own business but of the environment as well. And for meeting the standards of sustainability in modern world, there are different areas and there are different aspects the businesses have to account for, including the recycle of the waste or using the renewable energy resources as part of the external environment. I'm sure you all are familiar with the term globalization, as it has become the buzzword. The boundaries or the borders have been eliminated because of the technological innovations, and the world is ever more connected. So today, if a decision is made in country X, the likelihood is that country Y can get impacted. And we all know the impact even of some decision comes down even to the small size business, though impact might not be very big. For example, I'm sure some of you may be able to recall that we discussed a scenario that can your school's canteen be impacted by some global decision. And if you remember, we discussed it, that the impact or the influence might not be very big, but yes, it can get impacted. For example, the today's scenario of globalization, how this pandemic has impacted our lives, you could determine that your school's canteen business have been impacted too because of the additional holidays that you've got. School is not functional. School canteen is not doing its regular business. So, in today's time of globalization, the decision of supplying can impact the world market either in a big way or maybe in a small way, but the impact will be there. This globalization has increased the worldwide trade and the movement of people and capital between countries. So this means country A's decision of exporting products and flooding country B with a particular product at the throwaway price will definitely impact country B's local market. So the governments have to safeguard their local businesses by imposing tariffs or quotas, or in some cases duties on the imports. The governments might have to follow the protectionism formula or approach so that they can safeguard the domestic businesses from the businesses in different other countries. This is like safeguarding the domestic business from the foreign competition. So these tariffs are kind of taxes. These tariffs and duties are kind of taxes the governments impose imports. This free movement of goods and the increasing world trade today's leads us to talk about the exchange rate, which is the price of one currency in terms of another currency. And I'm sure you all are familiar with it. And we keep discussing that how the dollar rates impacts us and our economy. And you understand that today, maybe for $1 you have to pay 160 Pak rupees. So, a currency appreciates when its value rises and a currency depreciates when its values fall. So, I'm sure you can make out now that when a currency depreciates, this might sound or look good for the exporters, but it does not have all positive impacts. And when a currency appreciates, it might looks good for importers, but might not have all the positive impacts on the economy. There are many other factors associated that one has to study, but the fact, the matter of the fact is that yes, today the change in the exchange rate impacts the businesses and the economies almost at all different levels. So multinationals, while they are operating in different countries, they have to account for all these tariffs and duties and the exchange rates, and they would need to do all this financial computing to determine and to sustain and maintain their profitability. And you understand what's a multinational company. Multinational company is a company which is operating, which has its operations in more than one country. And today we all are familiar with many multinational brands. Just to highlight some common ones is Shell, McDonald's that come to my mind. And I'm sure while you are listening to this and you're reading through this slide, You can think of at least 20 different multinational brands that you're familiar with and interacting with or maybe using on a regular basis. So, with this is time to review and reflect. We've covered the 3 units, which is unit 4, 5, and 6. You're expected to catch up on your reading. You are required to complete your assignments available in your Google class and get prepared